This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manassero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manassero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help you generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we have a fun show ahead for you here. We've got a guest that we have had on in the past, and this is, I think, out of all my shows that I've had on, this is one I think I tend to reference the most when people ask me, or maybe they sound a little bit discouraged about getting into real estate investing, or I can't do it. And I just shared this gentleman's story, which is an amazing story. It's in episode 215. It came out June 25th, 2018. And it's called Husband and Wife Turn 50K Home Equity Loan into $56 million Real Estate Portfolio in just 5 years. And this is an amazing story about one starting with very little. And it's also just amazing as, how leverage works. I mean, there's so many elements in here about real estate investing in their story that I've just referenced it just nonstop, just sharing and talking to other real estate investors. But anyway, if you haven't guessed who it is, this is James Kandasamy. And James is a real estate investor, sponsor, and syndicator who has been in multifamily acquisitions and asset management since 2015. He has special expertise in finding value-add multifamily opportunities, and you'll hear that as you hear his story here. He has identified, underwrote, and overseen the acquisition process of over 1,400 multifamily units worth over $100 million, and also ran the execution of each business plan in the portfolio, averaging 20% IRR. James has a Bachelor of Science in Electrical Engineering from Science University of Malaysia and an MBA from the University of South Adelaide in Australia. Well, James, welcome back to the Old Dogs REI Network.
Hey, Bill. Happy to be here.
It's great to have you here.
Great to be back. Are we going to be doing the howling thing again?
Oh, of course we are. Oh, yeah. You can't
I'm really bad at that.
Oh no! Hey, your howl was really pretty good, actually. In fact, I'm going to invite our listeners to listen to episode 215, and let's rate on a 1 to 10 basis here, James Howl. No, you surprised me on that howl, so it was really good. I mean, you might even be in the who knows, in the finals for the Golden Howl Awards. So you never know, or you could beat it today.
Yeah, I'm gonna beat it today.
People have to keep listening because this is going to be quite an experience.
That's one unique thing that you have in your show. I love it.
Well, James, you do have a great story, and no exaggeration. Not only that, but you're just a heck of a nice guy, and the real deal. A very, just a very honorable, trustworthy, individual who works very hard. Has a business with their wife, and I know she handles the property management, overseas contractors, a lot of other things, and
Correct.
maybe that's changed, but and
No, it's still there. I can't I can't do that work.
yeah.
That's the hard part.
Yeah, well, I don't know. You're kind of the bloodhound here. You're the guy that goes sniffs out the good deals, and
Yeah,
you
yeah.
find these amazing deals. And it's so funny because I'll tell people, yeah, I've been looking. I was looking for 18 months, couldn't find anything. And I'm reading, James, oh, there's another one, 200 units, 300 units over here,
Yeah.
and I'm,
Yeah.
I'm going, gee, where's this guy finding? And you're still in your market, you're
Correct.
San Antonio. I mean, it's like it's amazing. I know you just got recently something in Austin area, but
Yeah.
yeah, but gosh, it's just a great testimony to how real estate investing really can work, and
Yeah.
if you do it right, if you do it right.
Absolutely. Absolutely. We just refinanced our third properties, a few days back, and we pulled out like 80% of our cash within 15 months.
No way!
Yeah.
Wow.
Yeah, and it's still going to be cash flowing high digits on the for the next after refi. So it's still a great investment.
Gosh, I'll tell you. After I interviewed you, I remember people would ask me, well, what are the prerequisites to be a good real estate investor? And first thing I tell everybody now is go get an engineering degree.
Well, I don't think there's an engineering degree. I think it's all about mindset, right?
Well,
So,
that's it. You got to have the mind though to be an
yeah,
engineer.
yeah. There's a lot of engineers out there, but not everybody can do what we do, because real estate is something that is a combination of marketing, communication. You can't just be a geeky engineer trying to solve all mathematical problems, right? You still
No,
need to have a lot of other skills.
You're right. I mean, you definitely need those analytical skills, but it's a very creative business, actually.
Yeah, absolutely,
You have to
absolutely.
be
I would say it's a lot
very
more creative
creative.
than engineering, and it's a lot more complex than engineering.
Yeah. Well, I am dying. I purposely, before the show, I was talking to you a little bit. I wanted to sort of dig in, but I thought, no, I want to do this on the air. I want to hear. Okay. I mean, it was so funny. Okay, I'll just tell my listeners this. I just submitted my my his bio to him just to make sure he could update it, and just like two minor changes, and I think at that time you had over 800 multifamily units. You now have over 1,400. At that time they were worth 56 million. Now they're over 100 million. Just two changes that I just kind of looked at. I just kind of wow, and that was only 9 months ago. So
Correct.
I am like, man, oh man, almost doubled what you did. It's crazy. And so I am just dying to hear, just bring me up to date, just what have you been up to?
Well, I mean, we have been, for the past 9 months. I think we closed almost like 1,000 units, which is crazy.
Wow.
So, and I think because of our track record, and we're able to find, good deals on and off market, both ways. So multifamily is still a great investment. It's just, good deals are hard to find. You have to be very, very careful on what kind of deals we do. So we are very selective on our deals, but we do underwrite a lot of deals. We do a lot of sniff tests, especially on the deals, and choose the right one and do it. But right now we have slowed down a bit, and we want to focus a lot on our operation efficiencies because we got a large number of units in the past 9 to 10 months. So that's what we're happening right now. We just closed like 370 units in San Antonio and Austin.
Wow.
And Austin is our backyard, right? We live here, and this is the first time we're getting a deal that makes sense in Austin.
Oh, that's neat. That's really neat.
That's what's happening in our life. And I just recently launched a book, which we're going to talk about it in a short while.
I'm very excited about this book. Yes, because it is one book that's in an area where there aren't a lot of books talking about passive investing in commercial real estate. So I'm definitely going to dig in there.
I am going to be launching my own podcast. It's called Achieve Wealth true value-add real estate investing.
Wow, that's
Yeah.
great. Oh man,
Just
well,
started interviewing yesterday, so hopefully it'll be launched in the next few months. So,
I better ramp up if I'm ever expecting to get a guest invitation, man. I'm gonna have to definitely ramp up here. Well, we got
yeah,
something hopefully under contract today, so I'm sending a
good,
yeah.
good,
So we got something happening finally here.
awesome,
But
awesome.
oh, that's so great, James. Well, congratulations both on the podcast and the book. I mean,
Thank you.
this is great. Did you find like as you were having more and more success and you were buying deals? I mean, all of a sudden you didn't have to like hunt as hard as you did for deals. I mean, no, you were doing direct mail. You're doing a lot of different things, and
Yeah, it is very hard to get deals nowadays. So,
yeah, where are you
so
finding? And you even mentioned you're buying on market stuff. So I want to hear about
correct,
that
correct.
too.
Yeah, yeah, yeah. I mean, on market we buy because we have advantage of being a local player. I mean, sometimes on market can be much better than off market. I mean, I know it's off market sounds cool and sexy, but nowadays, if you don't put on off market in front of a deal, nobody want to look at it, right? So every broker going around and telling this is off market deal, but actually it is on market because they are marketing to all the local players, right? So,
Right, right.
so, so the way the brokers work, it's very interesting. There's no deals. I mean, you'll get a true off market either if you buy it directly from the seller or if the broker knows that you have a deal nearby to this deal, then they might just try to sell it to you because you'll be the most qualified buyer at that point of time. And third off market, which is really good, is things that fall out of contract and they need someone to come and pick it up in a panic situation. All other deals actually on market, even though they say it's off market.
Ah, okay, okay. No, that's good to know. That's good to know.
Yeah.
Yeah, because I was gonna say like the on market stuff. I mean, the thing that I was running into is just so
Hmm.
frustrating is the institutional and international buyers out there that are
Hmm.
coming in and paying 10% over offering price. I mean, and paying cash for deals. And
Uh-huh.
how can the average guy compete with that?
Yeah, I mean, if you look for deals less than $20 million, most of the institutional guys don't play in that space.
Hmm.
So that's one criteria. The other criteria is, the institute. I mean, it depends on what kind of deals you're looking at, right? If you're looking at like huge value add, most of the institutional guys don't want to touch that because they want more core type of deal or yield deal, right? Also, and also you have to be, I think that two criteria would eliminate a lot of the institutional guys because they don't want to play in the less than $20 million space.
Right, right.
Right.
So are you still finding though in the realm that you're dealing mom and pop type operators or no? I mean, I know when you're starting out, you were
Hmm.
probably in
Yeah, starting out, yes, I was looking at it, but after that, the engine just started automatically. Brokers start bringing me, off market, on market deal. Even though on market, they would give, give preference to the people who are local and have units under their belt. Because brokers also one day they want your listing too, right? So they want to take care of you, right? So
Right, right.
at the same time, if they know you're a local player, you already know the sub-market, right? Rather than someone coming out of state and trying to bid, you do not know how are they. So the broker relationship works when you already have doing deals, right? But I am looking at new markets right now, and I'm going back to my tribal way of doing it, the what you call the ninja tactics or guerrilla tactics of finding direct to sellers because I can own as many
Oh,
I can own as many in my market, but when I go to some other market, I'm a newbie. Most
wow.
most of the brokers are going to give me the deals that the local players do not want.
Sure, sure. Are you looking out of state or
No,
actually?
no, no. It's all within Texas, but it's
Oh,
other
okay.
markets like Dallas or Houston or even Austin, right? So
Right.
um, so I have to start back my guerrilla tactics.
You have to get your voice going here. Start looking over your scripts and
Yeah, yeah, correct, correct, correct. So that's the only way to get started in a new market with a good deal, right? Otherwise, you'll get the worst deal. I mean, most of the time you get the worst deals. Otherwise, you go through this bidding process, and bidding process, end of the bidding process, you are the highest paying guy, I guess, right? So,
right, right,
uh,
exactly. Wow, that's now. What do you find different dealing with sort of the mom and pop owner as compared to now you're probably just dealing with, an executive team, an LLC, or
Yeah.
what's the big difference there?
I mean, I don't know. I mean, I know even I bought like my first deal directly from seller, like 45 units. They were not mom and pop. They were big brokers. But the
Okay.
problem is they're not multifamily brokers, right? And so the thing is, a lot of people in real estate, they do office, they do land, and they do hotels, and suddenly they hear a lot about multifamily. They said, "Oh, let me go and try to buy that and see." And they figured out, "Oh, I'm not good in multifamily." So the guys who sold to me in the first deal was actually a land developer. So they thought, multifamily is cool. Let's go and buy one multifamily. And later they thought, oh, we love land. We do not want multifamily because land doesn't make any, there's no property management issues, right? There's no tenants. There's no property managers who you need to manage. I mean, even though you give it a third party, you still have to manage them. There's no such thing as this automatic, right? So they decided, okay, we want to get out from multifamily. So they're big real estate guys, but they're just in different asset class.
Right, right.
So, yeah.
Well, as you started to expand, I know that your wife was handling these other jobs. You were more in the acquisition and probably the analysis side and so forth. But when you started acquiring, a number of units where it really was, this is getting big here. Who were some of the first hires that you had? Who did you have to bring in to sort of make up the difference there?
I think regional manager is our first hire, and because property managing all this, like we have like 24 staff or maybe 30 staff. I need to count my latest number, but I know before buying these two deals we had 24 staff, so maybe now we have like 30 or 30 something plus staff.
Really?
So yeah, managing them itself, managing the day-to-day issues, all the issues that pops out, it takes up a lot of my wife's time, and we are very grateful we got a really good regional manager now. I did hire an asset manager to do my underwriting and do some construction planning and all that, but that didn't really work out just because I didn't have enough asset management role for that person, and I'm still working with that person, but more on an hourly basis to do analysis and all that. But I think regional manager should be the first hire that any growing company should do, especially when you are vertically integrated with property management and construction and asset management, right?
Now, are the 30 people mainly people that are at your properties? They're
they
on
are
site
property
or
maintenance leads and all that, right? So
okay,
yeah, they are on site people. We only have my wife, I, and a regional manager at the corporate level.
Gotcha. But that must have been a huge weight off of you to get that regional guy. Oh,
absolutely. It's a big weight off. I mean, we can do to a certain level after that. We have 3 kids, so 3 young school going kids too. So we have to manage. We have to manage them.
You got to manage them too.
It's property management, family management. Or maybe I should add that, right? Family management.
I love it.
Family management, asset management, construction management, and property management. All kind of management.
That's great.
Yeah, it's hard, but it's all fun.
Yeah, it's great. And then the regional guy oversees the construct. When you say construction, you're talking rehab generally.
Rehab, and
you're not doing ground up construction.
Yeah, no, not that construction. It's more of a rehab and all the property management, issues on a day by day.
Gotcha. Wow. Yeah, that's got to definitely keep your hands full there, man. Oh man. Well, the you mentioned, and we, earlier on here about this book, and I'm very interested in this because I have a lot of people that I speak to that are that are 50 years of age and older, and many of them want to get involved in real estate, but they don't necessarily want the active role. They want to be able to invest in the right projects and get the great returns that everybody else is getting out there, and so I wanted to hear about your motivation behind doing this, and this is your first book, right? That you've come out with.
Yeah, absolutely. I mean, I have my ebook and I have a lot of blog posts that I write in my website. But I used to do a lot of webinars for my passive investors, and I find it very fulfilling and liberating because my passive investors are more educated, right? And we provide value to them, right? So, and that's why I wrote the book, because I want more passive investors to be more educated, because if you look at it, 95% of the investor base out there are passive, right? There's only very few, sponsors, right? And that's how syndication works. And there was no book for the passive investor side of it. And I chose to spend some time and write the book, even though it took like almost 1.5 years, because I'm doing deals as well, right? I'm not a book writer full time.
Yeah, just happen to be acquiring 1,000
Yeah,
units while you're writing the book. Yeah, just a little something on the side there. My
yeah,
goodness.
yeah. I remember telling this to my attorney who handled all my real estate. I say, did you read my book? She said, how did you find time? First question, how did you find time to write that book? That was the first question.
Seriously, that's immediately what I thought of
Yeah,
when I
how
found
did you
this out.
find time if I do all this? Because she handles all my transaction, and she was like, when did you write that? Right? Yeah, writing a book takes a lot of time, takes a lot of thoughts, and putting everything together, and making it nice, and your thought process. It's just so much of work.
Did you just dedicate a certain amount of time each day to write a little bit, or
It's like whenever I have time, I write. I don't have time, I write. That's why it took like 1.5 years, because whenever I have time, I write it. So
Sure, sure. Well, maybe give me an idea of like
sure.
what's in it, like some of the key concerns that people would have that are thinking about investing. And I imagine one of the key ones is doing your due diligence on who it is you're going to invest with, right?
Yeah, absolutely. So some of the things that we have covered is like how does passive investors can get started, right? So that's one chapter, and then I know what kind of deals that you should consider, right? So deal consideration and deal sponsor are the biggest chapters, right? Because these are important for people to know when they are starting up, because a lot of people starts up into commercial real estate because someone told them, and there's no real reference. The syndication or passive investment is not really well written topic. I mean, you can find a lot of topics on value add stock investing, bond investing. You can find tons of book, but not in syndicated commercial real estate investment. And that's why I chose to do that. And some of the other topics is like, what are the sources of capital that you can use? You can use IRA, you can use 401k, you can use what you call QRP or cash, and how does it work? And what is the process of communication with the sponsor, right, throughout the syndication process? Otherwise, new investors will keep on asking, hey, what do I do next? What do I do next, right? So now you can say, read this book, and you'll know the whole process, right?
Oh,
so,
that's
so
great.
these are some of the things that I've covered in the book.
Do you address, for example, that maybe there's the investor who maybe they've been investing for a little while. They've got a high net worth and liquidity, and let's say you're approached to be a sponsor for a deal. Do you discuss like the different players in that?
Yeah, absolutely.
Oh, you do?
Yeah,
Oh,
yeah,
great.
I did a breakdown of GP and LP structures, and I say who are the people usually in the GPs. Like you have equity raisers, you have property management, you have the actual sponsors, and you also have the operators, right? So these are the few people that they need to know, because when a sponsor show them their LLC structure, they need to understand who's playing what role, right? And what does each role supposed to do, right? So I did discuss about all that as well.
Do you have sort of a ranking or maybe I don't know, maybe it's a checklist or an evaluation? So like somebody's assessing, there's these four different projects, four different, sponsors, where they can kind of go in there and certain questions, certain things that they go through, like a checklist of to assess whether or not that's a good investment or not.
Yeah, well, the checklist is given as a complimentary or companion to the book. So if
Oh,
somebody
that's
buys
great.
I have a passive investor checklist that I've prepared based on the book, right? So the book will outline what are the things to look for, and the checklist is the companion to it. So I'm giving that out free for whoever buys the book. So they just have to email support@Achieve Investment Group. And the book comes with a free audio book as well, which will be mentioned in I think the second page of the Kindle version.
Okay, great. Are you going to do the voice? Are you going to do the audio?
Oh no, it's already done already. So I got
Oh, really? Oh, you got. Ah, man, I was hoping you.
everything is done. So,
Delegate. That's the key to your
yeah, I'm
success.
an
Got to be.
audible guy. I like to listen to audiobooks. I make sure there's an audible version for it. I got a
Same here. Same here. All the time.
professional narrator to read it out, and a lot of very good feedback from a lot of people on how the book came out to be.
How long a drive is it? Just from Austin to San Antonio?
2 hours.
2 hours? Okay, that's great audible book time, right?
Yeah. And the whole book is a 4 hour total read time, so you have to take a longer ride.
Yeah, that's true. Well, you stack them up.
Stack.
You get
Yeah.
another ones out there. Oh,
Yeah.
that's great. That's great.
Yeah.
Okay. So let me just kind of take a scenario here, if I
Yeah.
might. Okay. I'm somebody thinking of investing. Okay.
Mhm.
I kind of go through, read your book. I've kind of sorted out. Found one project that looks like it's a good fit for me.
Mhm.
And what's kind of the next step? Okay, do I contact that that sponsor? And once I contact them, what do I say? How do I get aboard? I mean, if it's got, for example, accredited investors, what do I have to do? So just there's just maybe those three things, just like how does a contact happen? What do I do? And if it's a qualified type of thing where you have to be an accredited investor, what do you do next?
Sure. So I've covered that in chapter 5. It's called the process. I mean, exactly what the question you asked me. So what I've written in the book and what I would recommend is basically, I think I'm sure usually the sponsor would do a webinar or would announce somewhere there's a deal happening. This is what it is, and once they think they are suitable for that, and you can basically give like 3 or 4 information, which is your name and how much you want to invest, and what's your source of fund going to be, and when would it be available, and also whether you are accredited or sophisticated investor. So these are the key points to note in your email to the sponsor, right? So because all this is very important, right? The other one that you can put is which state are you from, because the sponsor need that information, because SEC do request that we file in specific states whenever we raise money from there, right? So this 5 to 6 information is important to be communicated to the sponsor.
Okay, and let's say it's a deal where it's only accredited investors,
Mhm.
and somebody maybe has never actually, assessed. I mean, I meet the income requirements, the net worth, but so what do they have to do before the sponsor can accept them as as an investor?
So if it's a 506B, it's pretty straightforward. It's self-accreditation. So if you say you're accredited, the sponsor going to take your word as you're accredited, right? So, but if it's a 506C, there's a few ways to get you yourself to be accredited. But before you go and get accredited, you want to make sure that you are the deal first, right? So you want to make sure that you confirm in the deal with the sponsor whether you accept it or not. Because so let's say the sponsor accepted you that you're going to be in the deal, you can go to websites like verifyinvestor.com, where you can submit all your financial statement and they'll give you a letter saying that you are accredited, right? Or you can go to your CPA and get that accreditation letter as well. Even though a lot of CPAs don't like to do that. I mean, a lot of people say there's liability and all that. And you can also go and get it from a broker dealer, agent, and to tell that, to give you a certification letter saying that you are accredited. So these are the few things that you can do to say whether you are accredited in terms of verification. And also some sponsors also accepts like W-2 proof. If you can show that you have earned more than 200 or 300 if married, for past 2 years, W-2, they do accept that as well. But I like to just get a third party to get it verified for 506C offerings.
And just explain the difference between 506B and 506C.
So 506B, I've covered that in the book as well because it's important for passive investors to know. So 506B, you need to have a pre-existing relationship with the sponsor, and we do self-accreditation. I mean, as I said, there's no what you call reasonable verification that need to be done by the sponsor when they accept a passive investor in terms of accreditation, not in 506B, right? And 506B, you can take maximum up to 35 sophisticated investors, but unlimited accredited investors. But the key thing in 506B is you need to have pre-existing relationship. So you must know the person beforehand, right? Not like one day before the deal closed, but I mean a general guideline that was given by a top syndication lawyer is you must know the person before you go under contract to prove that you have pre-existing relationship, right? Whereas 506C is basically all need to be accredited investor only, right? So unlimited accredited investors, and there need to be some kind of reasonable verification done by the sponsor to know whether they're accredited or not. So there should be some proof given by the passive investors saying that they're accredited. So as I mentioned, verify investors, get it from broker dealer, a letter, CPAs, or somebody need to give the sponsor some letter saying that this person is accredited. And the big part about 506C is basically you don't have to know the person like yesterday or today, or you can advertise in the TV, in the radio, you can advertise anywhere, and still get that person to invest with you as accredited investors. I mean, of course, I'm not a CPA or lawyer, but this is the high-level guideline that was given to me by, syndication attorneys.
No, this is great. Excellent explanation. Now, do you do both? Like when you purchase properties under syndication?
I primarily do 506B. I only tried once 506C, which is on my third deal, and I was not very successful in 506C. I mean, it could be because I didn't really advertise it a lot, and it was a small deal. I was just trying it out to see 506C, but I think, but one thing I realized is a lot of people like to invest with people that they know, right? So I realized that 506B makes a lot of sense because I want to know the passive investors too, and the passive investors need to know you, right? So it's a bit hard to give 50,000, 100,000, 200,000 to someone you do not know, right? Just because they're popular or famous, right? So
Right.
I like 506B just because you know the person because you're going to be together with them for the next 3 to 5 years, I guess, right? And it just feels better to know the person.
Okay, no, that's great. That's great. Now, okay, so here it is. You've qualified. You're ready to go. What do you generally do then? Let's say it's a $50,000 minimum. So what do? You wire that money to them, or how do you get that? Can you write them a check? I mean, how do you get the funds to your sponsor?
So there's three or four ways that you can get the funds to the sponsor. I mean, make sure that you are into the deal first. And some sponsor do take in money even though they're oversubscribed, but I usually don't do that. I make sure that everybody's in the deal only wiring the money. You can wire the money. You can go and either wire the money to that sponsor's account, not to say sponsor account, is the account which the LLC name is, right? So make sure it's part of the PPM and the company agreement what LLC name is the entity that you're investing into it, not to a sponsor's account. Okay. So yeah, your money should go to the LLC name. Once you submit your subscription agreement and all the PPM document, now the sponsor is going to say, go ahead and wire. You can either wire, you can do ACH, you can just write a check and go into the bank and deposit in, or you can even mail a check to the sponsor as well. So these are the few things that I've seen sponsors, accept money from their passive investors.
Okay, so that person has to be sort of approved, though, right, before they can send that check, right?
Yeah, correct. I mean, you have to be, the sponsor need to let you know that you are in the deal, right?
Okay, that's the way they would put it, is you're in the deal, right?
You are in the deal, yeah, correct. You have to make sure you're in the deal because sometimes, I mean, nowadays, there's a lot of capital chasing the small number of deals, right? So it's easy to get oversubscribed. So as long as the sponsors tell that you are in the deal, go ahead and wire the money. You can do that. It's also good to get a subscription agreement signed as well. But usually, myself included, we do it at the end, just before closing is when we do the sign subscription agreement. back to the passive investors.
And
Right.
do you have people that are in the deal that don't end up paying?
In the deal doing
Let's say you have somebody that's okay, you qualify, you can get in the deal, um, and but they end up at the last minute changing their mind or something, and they don't pay.
yeah, I mean, people, yeah, I mean, that happens a lot of time, right? So
Uh-huh.
usually when we raise money, we go up to like 20-30%, right? So because it's easy to say I want to invest in the deal, but there are people who pull out as well. I mean, in the beginning they only give soft commitment, right? And some people pull out, right? So um so if you are really investing, make sure you give your word to the sponsor and make sure you invest with it, because sponsors don't like people pulling out the last minute, because they are doing multi-million-dollar deals and they don't want uncertainties and all that. And let me elaborate more on the process that I do. So I
Yeah.
basically create a PDF file of investment instruction for my investors, which is a password protected document. So I send that password protected document together with all the other PPMs to the investors. So if they want to, they can read all the PPM and all that. And if they like it, they can open the password protected document, but they have to text me to get the password. So I will give them the password through text, because it has all the bank information and all that, right? So once they're able to open, now they can see all the bank information, how to fill up the PPM, and then later they go and wire the money. And once they wire the money, they need to text me quickly. So I'll verify it immediately on the bank that your money is in. Okay, then I'll usually text them back, say confirmed, I've received your money.
Okay,
So
so you don't have like a third party that receives those funds.
oh,
You're
no. I,
Yeah. Okay,
I I
gotcha.
see it directly, and whenever they immediately after they wire the money or they deposit the money, they have to tell me quickly. That's part of the instruction that they have in the investment instruction, because I want to verify, making sure that I receive the money as well.
Got it. Got it.
Right.
Great. This is really good details. I appreciate that.
Yeah, correct. Some people do. They have an admin to do it and all that, but I'm, we are lean operation guys. I do everything, right? So.
No, that's great. And well, they're dealing with the person that they trust, or they wouldn't be investing in the first place. So
Yeah,
that's
yeah.
good.
And
That's
I want
good.
to make sure that I receive the money, whatever people are sending, because I can see it online immediately on who's sending, and I usually want to confirm them through text. And I use a lot of text as a security measures, because there's a lot of fraud happening in terms of wiring.
That's a good idea. Good idea. And you set up a separate account for this new LLC, right?
Yeah,
Yeah.
correct.
Okay.
Whenever we got after things go out of deal, one of the first thing we do is to create an LLC, and we create a bank account so people can start wiring money into that bank account, because you need to invest into that LLC, not into any other LLCs.
Sure. Okay. Okay. So now I'm kind of rushing ahead, even though I still have like a lot of questions here, but I think this
Yep.
is great. You're giving a good overview. And okay, so now they've signed up. Here it is. I'm on. Okay. Now what? Now what? I wait. Or what happens to the investor at that point?
So usually the way I do it is I try to send them updates like every 2 weeks, because we are busy with the closing. I mean, an investors doesn't they don't really wire money everybody at the same time, right? There'll be like 2 weeks gap, and people say, "Oh, I'm getting money from IRA, or my money coming from this closing." So we have to track all that into an Excel spreadsheet on when is the money coming in, right? So, and sometimes people do drop out at the end too. I thought I'm going to close, but looks like it's going to push out one more month. I'm out. Then you have to replace with the new investor. So there's a lot of things going back and forth between the sponsor and the investor, because it's like a 2-3 weeks process of getting all the money in, getting all the commitment in, and doing some IRA paperwork and all that, right? So every 2 weeks I send a mail update to every investor saying that where we are, what's happening, what's the inspection, did we do the appraisal, are we on track for closing, just to give them an update. I mean, not most of my investors doesn't really ask me questions after that, but a lot of people appreciate it, because they're getting update on what's happening with the money, because we haven't closed yet, right? So and just before closing, I will tell them we're going to close tomorrow, or on the day of closing, I usually tell them we just closed, this is what's happened, and this is the rate we got um, from the bank, and we rate lock at this, and then we close, right? So these are the updates that I give throughout the process, right? And on the day of closing, I tell them my next update will be when, so people don't keep on asking me after closing what happened.
Yeah, yeah, right, exactly.
Yeah, as long as you over communicate to passive investors, you tell them what the next step is, they're not going to be, bombarding you with questions, right? The key is to over communicate to them, because keep in mind, a lot of new investors are involved, right? I mean, people are putting 50 to 100,000 of your savings into you, and they're just listening to you, right? They basically trusted you with your money, and it's always good to over communicate to the investors.
Right. That's great. I totally agree with you on that one. And okay, so they've done that. Now let's say you're at the closing,
Mhm.
but you've had too many people put in money, like you're talking about oversubscribed, right?
Mhm.
So what happens in that case? How do you decide sort of who to go, who to return funds to, or what have you?
Well, I never really return funds, or maybe a very rare case.
Okay.
Um,
So you just take more than your initial asking.
Yeah, but I
Okay.
don't. I mean, that's all on the paper, right? But when people wire the money, I only most of the. I mean, almost all the time, I only request the money that I need. More than
Right.
that, I usually do not request any money, right? So, I mean, as long as people can give me a firm commitment saying that I definitely will get this money on this time, right? So there's a lot of people will be like, oh, I thought I'm going to close next month. I'm not sure yet. Or I think I'm very, so that are the uncertain people. So you have to be very careful with the people who are uncertain. I mean, they want to invest, but their capital source also is uncertain, right? So you as a sponsor, you have to be very careful, because now, especially if it's a big money, 300,000, and now you're banking on uncertainty. So it's a bit hard. So you have to go with people who are certain, who are going to give you money, right? And also the same thing for passive investor. Make sure when you talk to sponsor, you give them a very clear indication on whether the money is coming on time or not, or is it depends on some closing, depends on something that you cannot control. So that you're going to be fair to the sponsor, because, and as I said, we are under the gun, right? So even my last two deals, I had like almost like huge sum of money under contract. It's already hard, and I cannot really risk it for some passive investor who are not certain on when the money is going to come, right? So it's a lot of planning to make sure all the money comes on time. Whoever said they're going to give will give, but it's a lot of very, very stressful time for the sponsor.
Oh, I'm sure. I'm sure. So you hit closing, boom, paper signed, everything's done. Okay,
Hmm.
we've got the property now, and
Hmm.
so what happens now with the spawn? I mean, with the LP, for example.
So, I mean, LP, just relax, right? Let the
Yeah, really.
let the sponsor do their work, right? So yeah, I mean, so key thing is the sponsor need to communicate on when is the next report's going to be sent out, and the LPs or the passive investors need to wait for the report, and when they get the report, they can digest the information, make sure things are going as per the plan. If they have any questions, they can always ask the sponsor. But ask the right questions, or ask meaningful questions. So um, so yeah, because as I said, the sponsor is under the gun to turn around the property as well, especially the operators, right? They have a lot of things happening on the property they want to turn around. Um, so respect that part of it, but
So
keep
oh
tab
yeah,
on the reports coming in.
how often the reports usually come out?
I usually do monthly, and
Okay.
some sponsor do it. I do a full report monthly. That means I write up a summary and the financials together. Some sponsors do monthly, but they just do summary. They don't do financials. But there are a lot of sponsors who do quarterly reporting, right? But I like to do monthly.
And in there too, you talk about um, the payout that'll happen, right? So now
Yeah.
they've invested the money, they're going to start, pulling in some cash flow from this.
Hmm.
Um, how often does that happen, and what form does that take?
So that happens quarterly, right? But as
Okay.
I mentioned in my book, there's two types of compensation structure or distribution structure, or the whole syndication structure, right? One is called preferred return base,
Uh-huh.
or fee base. The other one is called equity split or profit split base, right? I like to do a lot of profit split base, because we do a lot of value add, and in value add, in the first 6 to 8 months there may not be any payout, because we're still turning around the property, right? Whereas on the preferred return base is more of a cash flowing deal with a light value add deals, and they may be able to do payout on day one, so they do a preferred return, but it's more heavier on the fees, right? Both structures, there's pro and cons. There's not that one is better than the others, but it's different motivation level for the sponsors if you look at both structures. So I've detailed that out very detailed on my book. So I usually do quarterly payout.
Okay, got it. Okay, and so then that process just keeps moving. You in your reports, basically, talk about how on target you are, and or off target, whatever it may be, and then do you also have any kind of webinars or connect, where you meet with the the investors in that process?
Um, Not really. I mean, unless we're trying to make a big decisions, like we want to
Right.
refinance or we want to sell, then we usually have a meeting, or I usually send a voting out to people. Um, you can do like a. I mean, I don't do this very frequently, but my monthly reports are pretty detailed. But some people like to do like a 3 months or 6 months webinar just to give everybody an update and all that. But I think I've given up a lot of information on my monthly reports, especially I do a detailed one, and a lot of people are happy with that from what I
Right.
see.
Right. And then you're basically just that continues for the number of years or whatever.
Hmm.
If and for your exit
Hmm.
strategy,
Hmm.
what let's say you have a possibility of a 3 or 5 year,
Hmm.
for example, but it reaches year three, and you don't feel it's ready yet.
Hmm.
How do you present that kind of thing to your investors?
I just tell them the truth. I mean, this investments are investments, and you can project 3 to 5 years sales, and every year it need to be reviewed whether it's ready for sales or refinance or what, right? So as long as you communicate that to the investors, I think everybody's good. I mean, most of the time people look for cash flow and making sure their investments are doing well, right?
Right.
That's the most important.
And do you have you ever had a situation where you've, let's say, decided to do a cash out refi, pay off investors, and then continue to hold on to the property?
So I don't do that. I usually keep my investors as partners throughout the process of refinance. I know some sponsors do that, right? They refinance, they cash out, and they buy out the investors. Well, I don't do that. I usually keep them throughout the process.
Now, would you hold on to a property for 10, 20 years?
Oh, that's a good question. Maybe, yeah, you never know, right? So every year we assess our performance, whether it's ready for sale, refi, or what, right? But we are long-term players. We like to do cash out refis, reduce everybody's risk and continue holding on to the property, because real estate is a long-term play, right? If you look at all
Right.
the tax structures, all the incentives that's offered through real estate, it's a long-term play thing. I mean, you can probably flip in 2 3 years, take out and get out. That's another strategy, but um, I don't know. We are long-term players. We like to keep the property for long term, because cash flow, the depreciation, all that makes sense. Above 5 years.
Oh, sure. Got it. So you would hold on. You may hold on to something longer term.
Yeah, yeah. If it's
Yeah.
especially if it's doing very well, there's a lot of upside. It's in a good area. And real estate goes up in a cyclic form, right? But the next cycle doesn't come to the same level. It actually goes up to the next level, right? So
Right.
property price always goes up. But we're still, looking at. I mean, as I said, we are like only 4 years in this business, right? But when I talk to people who are like 20 years, 30 years, they like to hold on for long term, right? And they have been doing very, very well, right?
Now,
And
what happens if you're an investor, for example, and you've been in it for 2 years and you want to get out?
oh, they can
Uh,
sell their shares.
they can.
They can
Okay.
sell their shares. So usually the way company agreements are written is basically you give the option to either the sponsor to buy your share, or you can sell it within your current LLC members. And if nobody buys this in this two level, the third level goes to, you can open up to outsiders to sell your share. So However, it depends, right? Whether the property is doing well or doing worse, right? So if doing worse, you may have to sell it at a loss from what you invest. Or if it's doing very well, you can always do an appraisal. You can ask this request to the sponsor and do an appraisal, and you can sell based on the appraisal. But and you have to look for people who are willing to pay for that uh, uh, the share, right?
Right. Okay, great. God, this is such good information. And I'm trying to just go through the cycle, and
Sure.
let's say you get to the the end of your exit strategy. Here it comes.
Sure.
What happens then?
So it depends on how your company agreement is written. Your passive investors, they may have a vote or they may not have a vote, right? So usually in my company agreement, I allow passive investors to vote together with the GPs, and we like to get 2/3 vote, to do a major decision. So either sale or refi, right? So let's say at sale, year 4, everybody decide to vote to sell, then we sell, right? So it's basically a voting strategy. And when you sell, you basically return the original capital back, or make sure that the investors are hold again before we split the profit on top of it at the sale. So once all the costs and everything is minused off, then we return the overall returns to the investors. Of course, there are other structures as well. In some of the fee based, there may be fees being charged by the sponsor at the sale point. So after all that's minus, that's where the passive investors get their total profit.
Okay, and then let's say that's the end of that deal. They get their money back. They also get their profit. And generally, what happens at that point? Do a lot of people want to stay in other deals or go into other deals? Or
First question is, do we have another deal or not? Right?
Yeah, that's right.
Because people want to make money. People want to continuously invest money, especially if the first one do very well. They want to now want to put into another deal, which makes more money, right? So, people always want to invest into the next deal. There are also people who create funds, right, where you don't have to invest in the next deal. You can just say put into a fund. So, and we can go look for another deal. So, but I usually let everybody, take their money back and do whatever they want. Unless I have another deal coming in, then they are always welcome to invest in.
Right.
So,
right.
yeah.
Oh, that's great. That's
Yeah.
great.
Yeah. And keep in mind.
Oh, yeah. Go ahead.
So keep in mind, when you sell, you are going to be doing a depreciation recapture at 25% on your whatever whatever depreciation that you took throughout the life of the cycle. You're going to do a depreciation recapture at 25% when you sell, right? So on top of that, if there's a capital gain on the overall investment, you're going to pay 20% of it. So that's how you convert your high tax bracket into a low tax bracket by using real estate.
Now, are LPs eligible for like a 1031 exchange, where if they take that money and put it in another investment, they can defer the capital gains?
No, they can't do a 1031 exchange on a syndicated model unless they use something called a TIC, tenant in commons. So you can take it and they can look for another investment which accept TIC model, tenant in commons model. So it would not be a syndication GP-LP model. It'll be a JV venture model where everybody comes in with their own money and do a TIC.
A joint venture thing. Yeah.
Yeah, right. Correct. So then you can do that. I thought about something and I forgot about it. So but you can't take 1031 from one syndication to another syndication.
And besides the depreciation, what other tax advantages are there for passive investors?
Well, I mean, first of all, you're converting your, let's say you are at 39 or 37% tax bracket. You are basically converting all your active income money into real estate, and then your cash flow is all tax sheltered with depreciation, right? So because depreciation is usually higher than your cash flow, you get a negative income. So on paper, you are losing money, but on actual reality, you're actually making money. But for IRS, you're losing money on the IRS bill, right? at the same time, at sale, you are basically recapturing back at 25% for depreciation, and you're recapturing at 20% for capital gain. So you're basically converting all your original income from 37% to 25% or 20%. So you're basically, it's a conversion. You're basically reducing your overall tax, liability to IRS through that method. So that's the major um, benefit of passive investors, unless you do some of the tricks to get full depreciation, such as, do you want me to go through?
Yeah, sure.
So unless passive investors become, slightly active investor, you don't have to be a full active investor, but they can be a slightly active investors by maybe buying like a 10 unit property and, being, just do a 10 unit property, but you may have like 1,000 units passive investment. But because of that 10 unit property, you are assumed to be, active investor, right?
No, really? Okay.
Yeah, that's the trick you have to do to get full depreciation, right? So now you get full depreciation. It's no more like 25%. You get a lot more depreciation. So you basically reduce your taxes. But you have to do these tricks to buy like small 10 units, 15 units,
Right,
or
right.
get one, is husband and wife. If the wife doesn't work, make sure the wife is categorized as a real estate professional by managing this 10 units or 20 rentals or 15 rentals, and it'll become real estate professional. Then your IRS category would be a real estate professional. Then you can get unlimited depreciation.
Good. That's great. That's great. Great tip. I got extra little tax tip there. That's awesome.
Let me give you another tax tip.
Yes. Okay.
Even though I'm not a tax or CPA and all that, but I do a lot of research, right? Because I wrote a book on it, right?
Sure.
So investing with IRA may not be the best option because you have to pay tax on the leverage part of it. It's better to go something is called QRP, which is another act in the IRS tax code. I think it's section 149. Is 401k act. So there's another program called QRP, Qualified Retirement Plan, which part of it is solo 401k, right? Where it's called as a checkbook IRA. When you invest your IRA using that method, you don't have any tax liability to IRS. Whereas if you go to SD IRA through Quest or through Trust ETC, which you use as custodian, you are going to pay tax on the leverage part of it. So if you leverage 80% of the investment, or if your sponsor leverage 80% of your investment, if your profit gain, 80% of your profit gain will be taxed. So I know it's a bit, not many people knows this. I'm not sure whether you know or not.
This is
But
good stuff. This is great stuff, man.
yeah,
Thanks, yeah, for sharing that. This is
yeah,
excellent.
yeah.
Wow.
All written in the book. It's called Insider Secrets to Financial Independence, right? I mean, that's the
Okay.
subtitle of the book. But that's a key tip that I think every passive investor should know, because a lot of time Wall Street's, Quest IRA, Trust ETC, and all these big IRA companies, they don't want you to know there's another loophole to avoid the tax.
Right. No, this is great. I think you got me. I got a hook in my mouth here. I think I had a button on Amazon right now. My finger on Amazon, ready to order because
Yeah,
this is great information. Great. You
correct,
really
correct.
really have done your homework on this, James. This is
Yeah, yeah.
fantastic.
Let me give you
Wow.
another tip.
Sure.
Give full maximum value to your listeners. So then the other tip is in Texas, and I think there's a few other states, but I didn't quote that in my book. But in Texas, there is some way to take out your 401k while working. So let's say passive investors are working somewhere full time, they're contributing to 401k. As long as you're married, and you have not retired, you can always take out that 401k using some expert attorneys to invest in real estate.
Yes, we actually have a 401 a solo 401k expert on our show,
Okay.
Dmitry Fomenchenko, and yeah, he teaches people how to do that. They go, no, but I got a full time job. How can I get a solo 401k? And he show it's really easy. It's
Okay.
not that difficult. Yeah,
Yeah.
so
No, but
that
solo
that's
401k is part
good.
of QRP.
Yeah.
So this is not solo 401k. This is just 401k.
Oh, this is just your standard 401k. Oh,
yeah,
okay.
yeah.
Gotcha.
Correct. That's part of the things that I mentioned in the book as well.
This is good. Good stuff. Man, oh man. Wow. Well, James, I could probably hold you for a couple more hours, but I think we'll both get weary, and I don't know where the listeners are, but I'll tell you, there's some really good stuff here, James. Any last things you might want to add? And plus, you might want to put some contact info in there too if people want to reach you. But
Sure. Yeah, you can reach me at achieveinvestmentgroup.com. Achieve, like achieving a goal. That's my website. There's tons of free blogs that I wrote myself and a lot of my webinars, which I do for my passive investors. Everything's uploaded over there. I have a YouTube channel as well. You guys can go and subscribe it. Every time I do a video, it goes in there, and that's great because we are operators, right? We do a lot of on the ground videos. You can learn directly from us. And I'm going to be launching my own podcast. It's called Achieve Wealth Through Value Add Real Estate Investing. It's focusing a lot on value add commercial real estate. And also you can find me in LinkedIn, James Kandasamy, or Facebook as well, James Kandasamy. So I have a lot of ways for you guys to reach me.
Great. Well, we'll have all those links in our website. But man, this is really good stuff.
Yeah. And make sure you get my book. On the second page of my Kindle book, there's a link to download a free audiobook.
Okay, great.
Yeah.
Okay.
But if you go to my website, achieveinvestmentgroup.com/free audiobook, you'll get it. You'll be able to get the audiobook as well.
Wow.
achieveinvestmentgroup.com/free audiobook.
All right. We'll put that link in here. Definitely, James. Well, James, I cannot thank you enough for being on. This is really, really good stuff. And I'm looking forward to, actually listening again, when I'm not trying to think of the next question and to pull from it myself. But good stuff. Sounds like a great book. And I think, I'm already, like I said, I'm ordering it today. So
yeah, it's amazing sometimes to me when people are willing to pay like $20,000 or $5,000 for some passive investor coaching program when people just do not want to go and grab a book from Amazon. Yeah. But the book is there now. You can go and get it, and it's $3.99 right now on Kindle version. So
God, who would not do that? I mean, that's great. That's great. Yeah. Oh wow. Well, James, we have come to the end, unfortunately, here, and I just wanted to. Everybody's really been waiting for this moment anyway. So you had some great info, but they're all waiting to hear this great howl that you're going to be giving. So
oh my God!
If you are ready, James, we're ready.
All right. Woo! Man, excuse me, I just can't do it. I give up.
No, hey, that was pretty good. It was kind of maybe it's a little sickly, the dog, but it's okay. It's all right. Yeah. Oh I like to put you on the spot. It's fun.
That makes your show very unique. So that's great.
Well, thanks, James, for joining us. I really appreciate it.
Okay, no problem, Bill. Thanks for having me here.
Our pleasure. And I also want to thank all our Old Dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. And please note, everything presented here today can be accessed in our detailed show notes. There's a lot of links. There's a book link, even a free audiobook link. Okay, so there's you'd be crazy not to go there at the Old Dog website at olddogsreinetwork.com/blog, and you look for the episode with James Kandasamy. So that is it for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.